All right, good afternoon, good evening. Welcome to today's live recap. So, heading into the open, our short-term bias was neutral, and that means that we had to be open to the market tipping in either direction. On the upside, we had initial resistance at 41.3075 to 37.75, and that was the intraday bias changing zone. And if the weakness from yesterday were going to remain in play and we were going to get any kind of follow through, then we wanted to see sellers holding ES below initial resistance. So that was a key inflection point. And in order for our intraday bias to turn bearish, we would need to see a breakdown below the pre-market support zones of 41.10 to 14 and 17 to 19, and we would need to see signs of initiative selling. So if in real time the market failed and rejected initial resistance, and then we saw broad market weakness come into play along with sustained downside momentum, and we got a break below pre-market support, that would be an intraday bearish indication, which could then bring the 40.95 half to 41.03 into play, which was the bias confirming zone. And again, you would need to see signs of initiative selling to take that area out, and a breakdown below initial support, below 40.95 half, is what would be needed in order for us to get a bearish confirmation, and that is when we could get some more selling pressure and downward acceleration. And in the event that we got a breakout above initial resistance, that would be an intraday bullish indication, and that could take the market up into the resistance areas above at 41, 42.75 to 46.75, where we could still get a reaction. But if the market is continuing to hold above initial resistance, then the bias would be bullish and the door would be open to test 41.54 quarter to 64 quarter and potentially 41.7475 to 83.75, where sellers were still very likely to be active because that is a larger time frame bias confirming zone, and our range potential would also be exhausted by the time the market reached 41.7475 to 83.75. So that was the market context heading into the open. Now let's jump into the chart and see how it played out. Now this morning was an interesting situation where we had some mixed signals. The S&P was in a very tight opening range, while the Nasdaq was actually starting to show some very clear-cut signs of strength. So NQ put in a breakout above the overnight high very early off the open there, and very early in the session we were seeing signs of strength in Nasdaq. That was a bullish Q, and looking at the NYC tick, it was holding above zero. It was relatively mediocre in the sense that we weren't seeing any big upside values on the NYC tick, but it was still holding above zero, so there was still a bullish skew on the NYC tick. And the advanced decline line was just kind of in the middle, not really providing us with any signal or any actionable insight. So as long as initial resistance is holding, technically there is still potential to go lower, but at the same time, the internals are relatively strong, the Nasdaq is relatively strong, and that created a very mixed environment or a mixed situation early off the open. And when you combine that with the fact that our short-term bias is neutral, well, now we have to be even more cautious regardless of which direction we're focusing on. Now, if you shorted initial resistance ahead of the open, that would be a valid trade because yesterday was quite weak, and initial resistance is the inflection point that is going to help set the bias on the day, which means that if the market holds below initial resistance, there is at least the potential for the market to head back down into pre-market support and possibly even lower. So if you're able to secure a good location in the pre-market session, it would be worthwhile to consider shorting the initial resistance zone. So if we take a look at the setup there, the suggested entry is 34 quarter, and that allows us to get a fairly quick scale out at 29.75, and then our targets from there are 19 and 14, which are just the pre-market support zones. So the nice thing about getting an entry at 34 quarter or above is that the market doesn't even have to break down below the overnight low in order to get 3R out of the trade. Now, that trade is set up in that way very intentionally, and the thought was that if the market does put in a stronger failure at initial resistance, and let's say in real time we start to see signs of initiative selling, well, then this target can always be expanded down to 4103, in which case it becomes a closer to 4R setup. So we can always change the final target to get more out of the trade. But given that our short-term bias was neutral, I didn't really feel like it was a good idea to be overly ambitious with the downside target, because again, we had to be open to the market moving in either direction. And when the short-term bias is neutral, it's a good idea to either wait for the market to open so that we can get more information about the session, the regular trading hour session, and how that is shaping up. Or if you do want to take the entry ahead of the open, then just get in at such a good spot that it's worthwhile to put on that risk without the extra information that we can gain following the open. And that's why 34 quarter was a good spot to take the short ahead of the open, take the quick scale out, and then once the market opened and we were seeing these very mixed signs where ES pulled back into the VWAP and then buyers stepped in ahead of the 24-hour mid, and then NASDAQ is showing very clear signs of intraday strength, that was a reason to consider taking another piece off within the opening range. So even though originally the high probability target was 19, it would be fine to get out of even that piece around 29.75 or so, or even 30. It doesn't really matter, but somewhere within the opening range. And that way, you're essentially risk-free on the trade. And if it works out, you can get 2R or possibly more out of it. But if it doesn't, then at least you're not losing on that short setup. The other thing you could do is the stop doesn't necessarily have to be outside of even initial resistance once the opening range got fairly established. So early in the morning, we can see that the opening range high was, I believe, 32, and then we kind of, ticked up a little bit higher and it became 33. And when it comes to determining the opening range, it's not just based on, the first X number of minutes, 2 minutes, 5 minutes, whatever. If the market barely makes a new high or barely makes a new low and then pops right back into the recent range, then you want to adjust that. This is a dynamic and fluid process. It's not something that's set in stone. It's not something that is mechanical based on, a 1 minute time frame or 5 minute time frame or something like that. What we're really trying to find out is what is that opening consolidation, that opening balance that gets established. It might happen in 5 minutes. Sometimes it takes 10, 15 minutes. So the timing is not so important. In this case, you can see that we balanced in a very tight range for over half an hour, which is quite unusual, especially given the strength that we were seeing in NQ. Now, once the market has balanced here for over 30 minutes, now your stop doesn't have to be up at 38.75. You can move your stop, and that's what I did. I moved the stop to 36 actually, which was like 1 or 2 ticks above the swing high here. Because if the market was really going to go down, then we shouldn't really even go back up to 36. So it was a risk-free short setup at that point in time. Now, at the same time, it would be completely fine to even get positioned on the long side. And there are 2 ways that you can do that. One is to secure good location. So, for example, you can lean on the VWAP and the 24-hour mid. So once the market puts in the swing low at 24.5 and you're noticing the tick holding above zero and there's potential for a breakout, one way to do it is to get good location, which would be somewhere near 24.5, and put your stop behind the mid and give the trade a little bit of room to work out. And if the opening range low of 24.50 holds and the midpoint over here holds, then we know there is potential for an upside move. That is going to get you better location, but of course, you don't really have that confirmation yet. The other way to do it is to trade the opening range breakout itself. So when the market breaks out above 33, you can put the long setup on right around 33.5 to 34.5, somewhere around that area, or you can wait for the 36 swing high to get taken out so you can get involved, above 36. You can buy at 37 or something. That would be okay. So that's the other way to do it, and that is an intraday balance breakout setup. And you can also have an intraday balance breakdown setup ready to go in case the market starts breaking down, because we know it's not going to stay in this tight range. We know that the market is building energy to go one way or the other, and a directional move is brewing under the surface. We just don't know if it's definitely going to break out to the upside or the downside because of the mixed signals in real time, but we know that it's not going to stay in this very tight range of 24.50 to 33. So what you can do is use the 41.33 level to set up the long, and use the 41.24 half or even the 24 mid to set up a short. And that way, as the market is breaking down, you're going to get filled on the flush on the downside. And if the market is breaking out on the upside, again, you will get filled on the flush to the upside. So that's how you can use the intraday balance breakout setup. And if the market does indeed go all the way up into the next important resistance, which starts at 54.25, and then of course the stronger zone is up at 74.75, then you can get 3.25 R out of that trade. And if it ends up only going up to 54.25, it's still a good enough setup at a little over 2.25 R, and that is with the 1 R scale out. So those are two ways that you can consider trading it. Both have their pros and cons. One is going to give you better location, better risk reward, but of course the downside to getting involved on the long side before the breakout is that of course you haven't seen that momentum come in yet. You haven't seen the directional move yet. We're still holding below initial resistance, so there is still technically that potential to head down. So if you want to be safer about it, I think it's better just to wait for the breakout and then get involved. But there wouldn't be anything outright wrong with getting positioned even before the breakout, given the strength on the internals and especially the strength on NQ. The other thing for those of you who are using Vulcan Trader in particular, now I know this is mentally very challenging to do, but Vulcan does allow you to hold a long and a short position independently, and you can manage them independently. So what I mean is that if you shorted 34.25 ahead of the open and you've already reduced your risk and now you're risk free, and you don't know if the market's gonna break out or break down, you have a good enough entry, you have no risk on anyway. At that point, for my particular trade, the worst case scenario was 0.8 R. So if I got stopped out to the upside around the 36 level with the scale outs that I had already taken, the worst case scenario in that trade was 0.8 R of profit, which is not a bad way to go. So that trade is already handled, right? Especially for those of you who are using Vulcan Trader for execution, that trade is going to kind of manage itself. You don't necessarily even have to think too much about that. You can very easily see what the worst case scenario is for that trade in Vulcan Trader, and it's 0.8, 0.9 R, I would just let it go. There's no point trying to, get a small profit on that final part of your position, because who knows? Maybe Nasdaq will fail at resistance and then ES will roll over. It's certainly a possibility. But once you're risk-free, then you don't really need to babysit that position anymore. And now you can focus on the long side. And you could actually put on a long trade, around the 24.50 to 28 area. And if the market breaks out, then you get stopped on the short. You are already long, and off you go, right? So that's one way to do it. The other is, again, use the intraday balance breakout setup. So right as your short entry is being stopped out at, whether it be 33 half, 34, 36, whatever, wherever you decide to put your stop, as that position is being stopped out, you can use a buy stop and trade the breakout right at that same price. And that way you are entering a trade on that flush higher, and you have all that momentum in your favor, and you just kind of get filled on the way up. And that's another very good way to do it. If you did not lean on the opening range, then the final way, or the final entry point, for the breakout at least, would be to buy the break above initial resistance. And in this case, of course, your risk reward is not going to be as good. And again, the target's probably a good idea not to be overly ambitious over here. I mean, 74.75 would be fine as the final. But this is another thing you could do, is take the entry at 38.25, scale out at 45.75, which is right within the next zone. And then your high probability target can be 54.25 and final at 74.75. And again, you're getting, pretty decent reward to risk, 2.83. And that would be a very safe and mechanical approach in a sense. It's a bias changing zone. The market has consolidated for over half an hour, pretty much right at that area of resistance. So if we do break out, there's probably going to be follow through now. There's even a higher probability of follow through because of that 30 to 40 minutes of balancing. Volatility contraction typically leads to volatility expansion. So that very narrow opening range, although it was a bit confusing in real time, like why is the market just stuck in this little range, it's actually very good for anyone trading the break when the market finally does actually break outside of that range. So that would be perfectly fine as well. But the main thing here is that you do want to be flexible enough to get positioned on the long side as the market is breaking out above initial resistance or above the opening range. And then the final long entry would be, if you're still not in it, then you can buy the pullback over here. We know that holding above initial resistance leaves our intraday bias as bullish. That was something that was very specifically discussed in the pre-market trade plan. So when the market is pulling back into this 38% retracement area, around 38.50, 39, that would be a good spot to get involved. And then the stop can just be behind the opening range high, where we also have confluence of the 61.8% retracement. This is a pullback continuation setup, and if the market is going to head higher, it really should not even revisit 33. But if you're getting in at, let's say, 39, you can put your stop down at maybe something like 32, just to be a little safe. And it's still, only a 7-point stop. And on the upside, as long as we get that range expansion, you can still get some decent risk reward out of that trade. So that would be yet another possibility to get on board on the long side. And from there, we can see the market does respond to the resistance at 42.75 to 46.75. We kind of consolidate here. We hold above initial resistance, so our bias is bullish. And after some consolidation, the market breaks out yet again, consolidates a bit ahead of the 54 quarter resistance, and then breaks out yet again. AD line trending up, tick above zero, printing nice upside values. So we are not looking to fade the 54 quarter to 64 quarter zone, because by that point in time, we already have more than enough clarity that the buyers are in control. The low of day is in. And now whatever range potential is left is probably going to play out to the upside. And the relative volume was healthy today as well. So there was certainly potential for the market to head up into the 4171.75 level and even the 4174.75 to 83.75. And then that zone had potential to cap the upside on the day, mainly because that is a better area of resistance, and the range potential would also be exhausted by the time the market got there. So you really want to be positioned on the long side early enough in the session where you can really take advantage of this upside move. Because if you're getting involved, very late, or if you're trying to trade a breakout over here, I mean, there's edge there, but it's not ideal. So you don't want to be so late into the move that you just don't get that much out of it. So I think that you really want to be positioned on the long side, either from around, the 33.5, 34 area, or at the latest by maybe 39 or 40. I wouldn't really go too much higher than that. I think it's going to be difficult to hold on to any trade if you're getting in at too high of a price. It's going to require more patience. It's going to test you. It's going to test your psychology. It's going to be tougher mentally for that trade to play out. So instead of having to sit through all of that and having to deal with the market going in your favor, then against you, then in your favor, and kind of just sitting there in limbo, well, you can avoid all that if you just get in early enough. And all these entries that I'm talking about are absolutely achievable by anyone who is watching this webinar and video right now. I mean, there's nothing that requires years and years of experience to take these trades. These are very simple, straightforward trade setups. You don't need a ton of experience to take these. They're very structured, they're very clear cut. And again, if you don't have as much experience, then maybe you should wait for the breakout above initial resistance, because then you have that intraday bullish indication. That's a very textbook and more kind of mechanical way of trading the idea, and a relatively safe way of trading the idea. But if you have more expertise in reading the market in real time, well, then the benefit of having that expertise is that you can probably get in earlier. You can probably get in around 33.5 or 36.5. And if you really want to get ideal location, then maybe you can even get in around 25.5 or 28.5, right? Again, each approach has its pros and cons, but these are very achievable trades that all of us can get involved in. And today's session, it's very in line with the morning trade plan, right? Our short-term bias is neutral. The intermediate time frame bias is still neutral bullish. NASDAQ is showing a lot of intraday strength. Yesterday NQ was more or less weighing on the S&P and kind of pushing it lower. Today it's the opposite. Today the strength in NQ is back, and it is now pulling the S&P higher. So these are all ideas that all of us can get involved in. This is a fantastic market environment. I posted about this on Twitter today. I sometimes see some messages from even more experienced guys, or guys who have a larger following than I do, and I don't know why, but some of these guys are very confused about what the market's doing right now. And I see a lot of complaining on social media about how the market is it's too confusing, or it's directionless, or it's too challenging, or it's just a difficult market, it's a bad market to trade, and I don't get any of it. I don't understand any of it. I don't resonate with any of it because for those of you who've been following along, you've seen the market has been quite predictable. It hasn't been crazy. It hasn't been low opportunity. This is fantastic volatility. The volume is good enough. The opportunities are great. And, there's a certain level of challenge that's going to exist in every environment because that is the nature of trading and that's the nature of the markets. Like if it were easy, everyone would do it, right? So you can't expect a high degree of ease when it comes to trading. There's always going to be a certain level of kind of baseline challenge that's going to exist in every single environment. That's par for the course. Now, can there be some days here and there that are easier? Sure, but those are the exceptions, not the rule. The rule is that most days are going to require skill. And thank God for that, because if they didn't require skill, there would not be any opportunity. There wouldn't be the potential for us to actually reap the rewards of putting in the time and effort to build that skill. So we should actually be grateful that it does require skill, that it does require expertise. And but despite all that, even if, let's say, the market is challenging, or let's say even if the market were in a environment where it was very difficult to trade, going in with the mindset of complaining about it is not going to serve you. So I think when it comes to your market views or your perspective or your beliefs, you have to think, is it actually going to serve you? Is it going to help you? Not at all. If you go in with the mindset that this is a super difficult market, no one's making money, and I'm going to kind of join the herd and also start losing money with them and complaining about it, how does that benefit anyone? How does that benefit you? It doesn't. So I'm telling you objectively, this is a great market to trade. It is a predictable market to trade. We've been following it along day by day, and it's kind of been doing what we think it's going to do and within the parameters of the trade plan, and the zones are being respected. And, I just don't think there's any reason to think that this is a difficult market. It's not. I mean, if it were, I would frankly tell you that it's very difficult. And there are some days that are more challenging than others. And I do mention on those days that, hey, this was a hard day to trade. But for the most part, this is a great market to trade. Yes, there will be some easy days and there will be some difficult days or more difficult days than usual, but the baseline is going to require skill. Like that's just a given, like that's the baseline for the environment, is that it will have a certain level of challenge. And if we approach that with the right perspective, we're going to give ourselves a higher chance of being successful. So anyway, just a bit of a rant, just because of what I see on social media is so counter to my experience and the way I look at the markets. And it's just very surprising and shocking to me when I see so much complaining about the market, because, I mean, what more could you want? These are such good ranges, and you have volume, you have volatility. Like, a few years ago, we had an environment where the average range was 10 points. Yeah, that was a challenging market environment. That was a more difficult one. That was like watching paint dry. This is fantastic. So let's hope it continues. So now, as we head into the overnight session, on the upside, the 41.7475 to 83.75 is still a valid area of resistance that is still intact, and we still need to see a successful breakout above that area in order to get a short-term bullish confirmation. So if we look at the daily chart, we're essentially dealing with this multi-day balance. We can see the market has attempted a breakout above the recent highs, and now in the overnight session, we're going to see if buyers can manage to hold the market at higher prices. If we consolidate in the upper part of today's range, then we could be setting up for a proper breakout above 41.74.75 to 83.75. So we don't really want to see too big of a pullback in the overnight session. The markets are at this inflection point. NQ has pushed back up into its recent highs. It hasn't quite reached the absolute swing high, but it got fairly close to its recent high. So we know the markets are at a decent area of resistance here. And now if we can consolidate in the upper part of today's range, so if we can consolidate above the 41.54 quarter to 64 quarter zone, then that would be a sign of strength. And holding above the zone can at least leave the door open for a breakout continuation above resistance, and a breakout above the 41.8375 would have potential to then test 4200 half to 10 half and 42.2075 to 30.75, and these are areas where sellers can still be active on first test. So the larger time frame resistance begins at 4200 half. That is the beginning of that big resistance. We could get sellers here, but if we push higher, these are the better areas of resistance where sellers can step in. So as we head into the overnight, we still should maintain a relatively neutral view, but with the idea that if we're holding above, the 54 to 64 area, then our smaller time frame bias is going to be bullish above this area. So I think this is going to be very key in the overnight session, 41.54 to 64. If we are holding it, then consolidating above that zone can result in an upside continuation move, or at least there will be potential for an upside continuation move. Now, until it happens, of course, we have to still be relatively neutral because this is resistance until broken. But if we consolidate here and then we get a breakout on signs of initiative buying, then that would bring these upper zones into play and sellers can still be active there. Now, if we break down below 41.54, that would be a warning sign for buyers, and that can then result in a move down into the 49.50 area and down into perhaps today's broken initial resistance. So at that point, if you take out 41.49, then maybe the market ends up pulling back into 41.32 to 42, where buyers can still be active. And if that area goes, then things could get bearish yet again. So by default, we are going to favor buyers above 41.54 to 64. Below that, things are going to get a bit mixed and neutral. And then if you take out the 41.32 to 42 zone, then I think things could get bearish. And this whole move at that point would be pretty close to invalidated. And then there would be potential to go even lower and test the 41.14 spot and even 40.95 half to 41.03. So that is how we're shaping up right now. And last Thursday we talked about how the market's probably going to put in some sort of directional move by Wednesday or Thursday. So far we haven't gotten that big, breakout or anything like that, but at least we've gotten some really decent movement, and the market has responded to the areas where we thought it was going to respond. And that was a week ago. So that alone should tell you this is a great market. I mean, if we can come up with even somewhat accurate forecasts a week out, that alone should tell you that this is a very orderly and predictable market. because that is a good sign. That is a good indicator. Because chaotic markets, you can't even predict tomorrow in a chaotic market. So if you can get a forecast that's even sort of accurate a week out, especially as a day trader, I mean, that tells you objectively that this is not a crazy market. This is not, this is very orderly. This is very structured. It's very predictable. Again, it doesn't, predictable, by the way, doesn't mean that you should be able to tell exactly where it's going to go and how it's going to go. And, we're day trading. There's skill involved. You have to be present. You have to read the market in real time. Predictable doesn't mean that you can say exactly what's going to happen days in advance, and you don't need to. And I'm not claiming that I can do that. But areas where we think there's going to be a response, there's a response. Key zones where we think buyers are going to step in, buyers step in. When a zone gives way, if it's a bias changing zone, it should result in continuation away from that zone. That kind of stuff is predictable. It's predictable to the point that we can trade it. And that's all we need. We don't need to look out a week. We don't need a crystal ball that's going to predict what's going to happen 5 days from now. It doesn't even do us any good because we are trading on a very small time frame. We are active day traders. So we just need a framework that allows us to take advantage of market movements in a consistent way. And we have that. So, it's a fantastic market. Environment's great. Everything's looking good. Volatility's good. As we've been saying for months now, given everything that's happening around the world, it's probably going to continue. There might be a bit of a slower period, maybe over summer, which is pretty typical. It's seasonal, but so far there's no sign of the volatility getting crushed or anything like that. So that's the view. Let me see if there are any quick questions that we can cover, and then we will wrap. John is saying right at the end of the first hour, the price ticked up 2 ticks above balance. Is that a legitimate signal to be thinking the 70% chance that low of days in, or do you generally want to see it go outside by a few points? Well, you want to see a proper balance breakout. So it's not even a matter of like going outside by 1 or 2 points or 3 points or anything like that. I mean, you want to see a successful and sustainable breakout. And as long as you're getting that, then you can say yes, the low of days probably in. But it's not about did it take it off by 1 point, 2 points, 3 points. The idea is that you want to see the breakout holding. You want to see the breakout sustaining. So, for example, today, at what point in time could we say that the low of day is very likely to be in? Well, once we got the breakout above initial resistance. At that point, the low of day is likely in. And keep in mind that there were already bullish indications along the way, right? The AD line was already holding up really well. NASDAQ was leading to the upside. So there were already a lot of bullish indications stacking up prior to the breakout. Tick was looking good, right? Again, no big upside values, but certainly not any big downside values either. And when you combine it and take a holistic view, and then you see the breakout above initial resistance, at that point you can say low of day is very likely in. So I don't even think you needed to wait for the break above the first hour high is what I'm getting at. In this situation, you didn't have to wait for the first hour high to get taken out. You just had to see the market put in a balance breakout. That's it. Because, the first hour high-low stat, it's an easy statistic to come up with. It's very easy to look back and look at just the first hour high and low and run a stat on how often does that end up being the high of day or low of day. It's simple. If anything, it's overly simplistic. But the principle behind it is not the first hour high low. The idea is that you're getting a successful break outside of that balance that typically forms in the first hour. But the first hour high low is just a way to get a stat. It's an easy way to get the stat because it would be much more difficult to look back and define the appropriate balance area in the morning. Sometimes it takes 30 minutes to develop. Sometimes it takes 70 minutes, sometimes 90 minutes, whatever. it's very difficult to do that programmatically and then run the stat on that. First hour high low is just an easy way to come up with that statistic. But you really have to understand the essence and the core principle behind it. Otherwise, you're going to not really end up with the right insight. So I wouldn't get lost in the stats. I see a lot of people using stats almost like just overly mechanically, and they put a lot of faith in the statistic. But you have to look beyond the stat. You have to look behind it. Like, why does it work the way it does? Dissect it. I mean, that's how I learned how to trade. Is I started kind of taking these things apart and trying to put them back together, because my background's in software development, computer science, engineering. So the way I learned about the markets and trading was to dissect it, break it down into its component parts and really try to get at the core principle behind why something works the way it does. And once you do that, it gives you, of course, much greater understanding, deeper understanding. But then when the stat matters and when it doesn't. And that's really, I think, where you want to get to. It just gives you such a high degree of clarity that, trading literally becomes easy in like 90% of situations. Not saying that there aren't hard times, but, if you really get to a deeper understanding, it does get much, much easier. Jim is saying, since the opening range was right beneath initial resistance and internals were two-sided, on NinjaTrader 8, I was hesitant to go long. Being two-sided internals, I thought ES would fail under initial resistance. Did I misread the context? What data feed should I get to see the best internals? I don't think you misread the context fully, but I think that if you have that view, you can just wait for initial resistance to get taken out and then go long. Now, the internals weren't bad. Like, the internals weren't bearish. So perhaps there is a bit of a misread on that side. They weren't bearish in real time. I mean, the tick was holding up pretty well. So it's not like the internals were bearish. And if your internals are looking bearish because they are calculated and differently for each data feed, then TradeStation is what I use. This is the platform I use for charting for majority of my charts, and I think that the market internals are very good in TradeStation. I think they're quite good with eSignal as well, although I haven't used eSignal in quite some time. But in my experience, TradeStation has a very accurate New York Stock Exchange tick, and I think the internals work really well. And I also think that there's not really a single platform that is ideal for everything. As an example, TradeStation doesn't have appropriate support for volume profile analysis. This profile that you see here, this is a rough estimation by TradeStation. This is not accurate. It's okay. I mean, it's not terrible, but it's not as precise as it could be. So you have to know the strengths and weaknesses of each platform, and based on my experience, there's not really one platform that does it all. And that's why I have TradeStation. I also have Investor RT, which I use only really for volume profile analysis. I have NinjaTrader 8, which I use for execution, and of course combined with Vulcan. If I had to use just one platform, it would have to be NinjaTrader 8, and I would just get a better data feed. So if you want to limit yourself to one platform, which is fine, it's nice to keep things simple too, there is a benefit to that, then NinjaTrader 8 with perhaps eSignal as the data feed. I think that could be a good solution. Lauren is saying, in the morning when NQ was moving up to 13,088 to 13,129, was it a strong enough area of resistance to reverse the earlier bullishness and pull ES lower as a result? I think it was pretty good resistance, and that's the only reason that I was still holding on to a short position off of initial resistance. The idea was that yes, NASDAQ is strong, but at the same time, it is a bit overdone into resistance. So maybe sellers are going to step in and maybe that'll result in ES pushing lower too. But things were so mixed that I exited my high probability portion of the trade very early. I wanted to be risk free because it was too mixed. I wanted to be risk free and also get positioned for a long side. So I think there was certainly potential. The area that you're talking about, I mean, that's essentially the equivalent of 41.54 quarter to 64 quarter, right? And if ES had shot up off the open, straight line, into 41.54 quarter to 64 quarter, we would almost certainly short that area first time up. So NQ was testing the equivalent of that. So there's potential for it to turn around, but then you have to see what the response is off that area. If it's just a reaction and the market's holding up just fine and sellers are not stepping in and you're not really getting much of a response, then you have to adjust your view. The whole idea of a short-term neutral bias is that the real-time intraday context gets more weight. So in that situation, you have to have a lot of flexibility. You can't just have one view. You can have an idea, but then you need to have the market prove out that idea. So as an example, initial resistance, perfectly fine to short it ahead of the open. But then when you notice that buyers are stepping in at the VWAP and midpoint and holding ES above the midpoint, you need to take that into account. And you need to adjust your risk and exposure accordingly. And you can compare, today to yesterday. Very different type of move. This morning we end up getting this upside move, and you can see that it's essentially holding the 50% retracement for the most part. It's not really taking out the launching point. Whereas yesterday, we have this big upside move, but we hit much more significant resistance. We come back down. First time down, we still hold the mid, but then we just slice right through it. And that really kind of changes the whole context of that bullish movement that happened pre-market. So today is very different compared to what we saw yesterday. Haas, if you go to my YouTube channel, there's a video on there that explains how to set up the profile chart in TradeStation. And again, keep in mind, this is not as precise as I would want it to be. This is kind of an estimation because TradeStation doesn't use tick level data to build the profile. It uses 1 minute data, and it kind of spreads the volume across the entirety of that 1 minute bar to come up with the profile here. So, as an example, looking at this, it'd be kind of hard to tell, like, is the HVN for the day, the VPOC for the day, is it around 27.5 or 27.75, or is it up closer to 73? It would be a little difficult to tell based on this chart. So it's not as precise, and that's why if you do end up using TradeStation for volume profile, just know that it's not super precise and give yourself more margin of error if you are going to use the profile on TradeStation. All right, guys, I think that wraps it up. That's all the questions. So we'll end the webinar here. Thank you for attending. I hope you all traded well. And as always, we'll reconnect bright and early tomorrow morning. Take care and enjoy the rest of your day.